conference call, would like to extend my warm welcome to all of you for joining us today. Today, on behalf of the management, we have with us Mr. Vineet Agrawal, Managing Director, and Mr. Ashish Tiwari, Group CFO. At this moment, all participants are in listen-only mode. Please note that this conference is being recorded. I would now request Mr. Ashish Tiwari to embark on this meeting. Thank you, and over to you, sir.
Thank you, Simran, and good evening to all of you again, all the participants. Warm welcome to my this quarterly investor call. We will begin with opening remarks from our MD and then followed by the presentation. So I will invite Mr. Agrawal for his opening remark and presentation. Thank you. Over to you, sir.
Thanks, Ashish. Can you please put up the presentation? Good afternoon, ladies and gentlemen, and thank you for joining today's conference, investor conference for TCI. So I would like to start by giving you a little bit of a brief of the last quarter. The quarter that went by, Q4, was a good quarter for us overall. The last quarter is typically the best quarter for us, and we saw that some of the businesses and all the businesses actually did relatively well. We saw good growth coming from our supply chain business, where we saw automotive growth really picking up. Especially in the month of March was quite exciting because we saw good growth in all the divisions across. And typically, what we've also seen is that the core sector remains strong, though there are certain sectoral issues. Of course, cement is a bit flattish, as we know. We know that steel consumption is also has increased, but the positive things are that e-way bill numbers are extremely high. They are moving, which means there's a lot of movement that is happening, as well as movement that will continue to happen going forward. GST collection is also very good, very robust, again indicating that the macro factors remain quite strong. Certain sectors are a little weak, clothing, apparel, and some of the consumption sectors, specifically because of, I guess, maybe some sentiments around the elections as well as the higher interest rates. On the auto side, barring tractor segment, generally good growth is seen across all segments. There is the increase in the EV side of sales for a lot of customers. The customer discussions around alternative fuels have also increased, which has a bearing on the commercial vehicle sector as well. There is a certain amount of impact that we are starting to see, which is positive, which is the integration into global supply chains. There are lots of clients that are now talking about both an export exit, that is an EXIM kind of a business opportunity. So I will talk more about some of these things as we go through the presentation, as well as when you have your questions. The business remains solid in terms of the kind of strengths that we have with our 6 decades of experience and a very strong manpower force. Next slide. I think this is well known, but just the impetus around logistics has been phenomenal for the country as a whole. And I think this is going to remain with whichever new government comes in. We do believe that this will have, there are some trends which are irreversible now in terms of what has to happen in logistics, which is, for example, the spend on infrastructure. Other than that, the consumer trends are always changing. There is a certain amount of demand that is going up and down, whether it is related to quick commerce or e-commerce. And then differentiated logistics services increase is also being felt now, where customers want more and more different kinds of services. The PLI schemes are now, a lot of them are in place. So what we do believe and feel is that over time, some of these Now we will see production actually start happening for many of these sectors, and which will have a direct impact on logistics as well. Just the fact that there is so many cell phones getting produced in India is leading to the fact that there would be a lot of SMEs that need to really become suppliers to these large companies also. So there is a high potential growth opportunity for many MSMEs also in this PLI scheme. Going forward, the company strategy, our USP remains the clear differentiated wide range of services that we have been a factor of our consistent growth. We have built in the last decade a very strong, unbeatable multimodal network of road, rail, sea, and the entire operations is, of course, tech run. We've been also continuously incubating several high growth sectors like the cold chain and so on, and we will continue to do that. Going forward, these are the list of services that we have and the sort of verticals that we service today. We are present in almost all the high-end, high-tech, high-end kind of verticals where we are able to essentially extract more value in versus doing more commodity kind of transportation and logistics services. So energy renewables or aviation defense or even the chemicals side, we've been able to service our customers with very high degree of value-added services. Customers like all of this because they are able to see a single window solution as well as they get overall operational cost efficiencies. The next slide is an example of a case of a company that has set up a FMCG customer setting up a DC. And earlier the setup was a very legacy-based operations where the overall inventory accuracy or visibility was very poor. The cost was not very visible, and there was, of course, sale issues that peak time there was difficult to manage demand, etc. And of course, with stockouts happening, customers lots of customers also there. So we suggested a solution which was a completely rack-based solution, and we were able to reduce their area requirement by 40% and increase all the major throughputs, all the SLAs around productivity, around accuracy, around transit times, around speed of delivery. This is approximately 1.75 lakh square feet facility. And like this, there are several such discussions that are underway with customers across the country around the pipelines is quite strong. In terms of multimodal from a road, rail, coastal perspective, last year we moved about 2,300 rakes across the country. And this has increased in the last 3 years from 1,372 rakes. So this is a clear demonstration of movement towards more and more multimodal activities. Close to 35%, 33% of our business is now coming from multimodal businesses. In terms of the rail operations, just go back, please. Rail operations, we are handling from about 60 terminals across the country. Ships are touching 7 ports, and the road network, we have 25 hubs, as well as 65 yards to service last mile for finished goods for the automotive sector. This network effect is very unique because this combination of road, which is the on the ground network, combined with other assets around rail as well as sea, makes it unique because we are able to move customers across various modes of transport seamlessly. Technology is a given for our business now, and the core business has a very strong ERP system. We built a cybersecurity layer around it, as well as a high degree of digitization that already exists. We are present in many sectors, and some of these sectors that I mentioned here have definitely a larger growth trajectory, and we are able to service them with our specialized, specific products, and sometimes even standard products, but they are able to essentially use our services across the value chain, across their entire supply chain, actually. Coming specifically to numbers, the quarter four was the highest quarter for us in so far, and every quarter has been higher than the previous year's quarter. The diversification of our services has definitely helped, and we also have no net borrowing is still at zero with about 350 to close to 400 crores of cash. Specifically around freight business, the freight business for some of you is a business which requires both FTL and LTL. For most customers, there is a need for providing services from any place to any place, as well as customers are now looking for more and more digitized solutions. So we do operate control towers for a number of our clients. Next slide. We have 25 hubs across the country and provide single window solutions to many of our clients. And as explained at one point, for some customers, we now have bots that read their orders and place them into actionable items, actionable placement of trucks, and then subsequent tracking of trucks, etc. The business was slow last year, and mostly because we were not able to grow our LTL business because of competitive pressures. We are seeing that there is some competitive pressure, not just in this business, but also coming from the express side of businesses, where some of them are starting to move down to lower pricing models, and that has had some impact on the LTL side of business. But we are now confident to push this harder, and we're moving towards 40%, not next year, but the year after next. The EBIT margin has come down to 3.4% for the full year, though the quarter was relatively better from a revenue perspective, but from a profitability perspective, it was slightly, surely lower than anticipated. The return on capital remains at around 20+%, and we do expect to maintain this as well. On the supply chain side, the network effect as well as the impact of the kind of services we provide is very high. We are a company that is known in this business of providing high quality services as well as deriving value for the customer whenever it comes to their needs. And we've had consistent growth here for the last 2 decades. And the business, though 75% is in the automotive and related areas, it still has a high degree of growth, because as we know that automotive sector contributes a large percentage of the manufacturing sector anyways. The number of vehicles that we have moved in this or are under operation has increased. The yards have increased as well. We are now handling more than 1 billion parts, production logistics parts every year. And as mentioned, more than 150 trains per month for the finished goods movement of automotive, through which move from a hub and spoke to our yards. We've been able to enhance our warehousing space to about 15 million square feet. The business did relatively well in the last quarter, grew at about 11%, and the top line for the full year grew at about 14%. Again, the automotive sector has had good traction. Of course, we know that the tractor segment did not do as well, and the earth moving equipment, but the other segments have done quite well, including the two-wheeler segment. The EBIT margins have moved up a little bit, as well as the ROCs have also moved up. On the Seaways side, next slide, is 6% is the current modal mix of Seaways, which the government has planned to increase to 12% by 2030, which includes Indian waterways as well. Next slide. Our capacity expansion has unfortunately not taken place here, and the two ships that we had got cancelled. So we are still in the market to look out for buying two new ships, and we're talking to new shipyards. Hopefully, the next few months we should be able to get a better connect on that, and we will add. We've added 75 crores in terms of the proposed capex for this, in case we are able to tie up the new ships. Anyways, any such delivery will anyways happen after 2 to 2.5 years. So in the meantime, by the end of this financial year, early next year, we are also looking out for a second-hand ship. The business was expected to come down. However, in the last quarter, it has moderated. The revenue growth is still flat, but still not negative. Overall, for the full year, it is about 7% negative and 16% on the EBIT levels. Again, this had to come off. We were talking about how we were at not necessarily at the optimal levels, and I think we are slowly getting there. Next quarter onwards, we will see lower EBIT, lower depreciation for this business because almost a lot of our ships are already depreciated. Fuel prices remain in the last 4 months, actually, fuel prices have again gone up, the bunker prices. And out of the 3 ships that require dry docking in FY25, we've finished 2 already. On the joint venture side, the Concall joint venture did reasonably well with a 13% top line growth and approximately 10% bottom line growth, 10 to 12% bottom line growth. The cold chain business grew at about 35%, and the Transsystem business grew at about 46%. The Transsystem business has done quite well over this year because of the strong growth trajectory that we are seeing at Toyota. In terms of financial numbers, standalone numbers for the year are up by 6.3%, and PAT numbers are up by 8%. For the consolidated level, the consolidated numbers for the full year is up 6.7%, and we've crossed 4,000 crores. The EBITDA has also crossed 500 crores at a consolidated level, and PAT is at 354 crores for the consolidated level. EV EBITDA remains strong at 13 times. CAGR growth in profitability is at 20%, and business remains at 24%, excluding the cash element in terms of returns, and roughly about a 20% return on net worth. The dividend payout is about 15 to 20% every year, and this year also that has been maintained. The ratings have not changed. We've added a Dun & Bradstreet rating of 5AA, which is the highest category possible. We have been doing a lot of work on the ESG side. On the environment side, I've mentioned about how 30% plus revenues come from multimodal, and this has increased in the last year. We are producing green points for our clients as well, and vehicles have been converted into CNG. As well as on the social side, again, a lot of activities are underway. From a road safety perspective, we are providing one of the largest road safety programs in the country today with our Safe Suffer initiative. Next slide. The expectation for the next year is about 10 to 15% from both top line, bottom line. I think we are a little bit more confident this year. We do expect Q1 to be not as strong as it usually is because of elections, but given the fact that it's expected to be a good monsoon, monetary policy might get eased, we do expect this year to have a strong festival season as well. We are maintaining a 375 crore budget for CapEx with 100 crores odd in hub centers, small warehouses. I mentioned about the 75 crores for the ships, and trucks and rakes about 100 odd crores, and similarly about 7,500 crores for containers and other equipment. Thank you so much, and I look forward to your questions.
Thank you, sir. Thank you, sir, for the valuable insights. Ladies and gentlemen, we will now start the question and answer round. If you have any questions, please use the raise hand feature in the call. I would request you to start with your name and organization name followed by your question. So the first question is from Mr. Jainam Shah. Sir, please go ahead.
Yeah, hi, good afternoon. Am I audible?
Yes, yes, please go ahead.
Yeah. Hi, sir. Thank you for the opportunity. Sir, just wanted to deep down on the growth and revenue and growth, profitability growth part, where you mentioned 10 to 15% growth overall. If you can highlight something on the sector specific part as well as how the JV is expected to perform in this particular year, and like any bifurcation of this 10 to 15%, any sector or any segment we expect to perform better, any segment to perform a bit lower or something.
We do expect the supply chain business to definitely do much better. We expect the seaways business to be a little bit more on the flattish side, and the freight business to be slightly positive. And the JVs are also expected to do well. So there should be some contribution from that as well. So it's going to be a mixed bag from all around.
Okay, sir. Then, sir, just wanted to confirm on this capex part. Are we envisaging capex for addition of second-hand ships for this year, or it will be rolled to the next year? Because in this presentation, I guess this 7 crore has been mentioned for the ship capex.
70 crores. 70 crores is mentioned for it's a capex. Actually, that's incorrect. I'm sorry. It should be 70 crores. There should be another
70
zero there. Yeah. So
Okay.
70 crores is the capex for any new ship that new orders that we might place, and this will be the advance of that order. A second-hand ship is thought about, but we've not taken it into the budget yet because we don't have a visibility of that. Maybe in the 6 month mark or maybe in the next quarter, if we get a better visibility, we'll certainly add that on.
Got it, got it. And sir, just wanted to check on one board resolution that we have passed about 200 crore of fundraising through debt instrument. So is it just an enabling resolution, or are we going for the increase in debt through these instruments?
No, it's just an enabling resolution.
Okay, as we are having around 300 plus crores in the current investment, it will be majorly mutual funds, right?
They are mostly commercial people, yes, and some part is in the mutual funds.
Okay, got it, got it. And sir, as this year would be might be lower or maybe flattish for the shipping business, how we are expecting it to be on a longer term, maybe 3 to 5 years perspective, given that new ships would be added and there might be some existing ships that might get out of the system as well. So how we are looking at this sector from 3 to 5 years perspective?
Definitely a growth element. The sector will grow. The business should grow for us. We are adding capacity because we believe in the sector, and it is very critical to our overall strategy of providing multimodal services. Government initiatives are quite good. There are ports coming up. There's also only tonnage tax in this business, so it is attractive if you know the business and you're able to provide the linkages like we have of our branch network as well as the multimodal capabilities. So yes, it is a sector that we are definitely quite bullish about.
Got it. And so just one last question from my side. In your commentary, you mentioned that in LTL business, there has been a competition coming from the express players as well, who are cutting down the rates or maybe charging lower as compared to what they were charging. So how the exit things are going on? Like it is on specific routes, or few specific players are cutting down the rates at the cost of margins, or is it like just a temporary phenomena that they are doing?
I do not know if it's a temporary phenomena or permanent phenomena, but I can definitely see that some of our competitors who are losing money are well. We've not considered them as competitors till now, but we do feel that some companies that are losing money are really trying to get into this space as well to bring down. I mean, just capture market share. So. But I think long-term trends have to be seen where we have to keep a watch on those customers that are essentially we are providing multiple types of services. I think those are more sticky to us, as well as ultimately customers see a lot of value in the delivery systems that we have, The fact that we are providing safe, secure services and ethical services, I think that those are things that will really play out in the future.
Got it, sir. Got it. Thank you so much. If I have anything, I'll join the queue again. Thank you so much.
Thank you.
Thank you, sir. The next question is from Mr. Alok Tiwara. Sir, please go ahead.
Hello, good evening, sir. Just a couple of questions. First, on the Seaways division. So, sir, what's the status on the second-hand ship? I mean, are we in discussion with any, any party for that, and if that comes, then would we be placing the order for the new ship also, or does that go parallelly, or if one happens, then the other one takes a backseat?
No, so what the first priority is to look for new ships, that is, buy them and place the order, because it's a little bit more of a long-term play. It is not going to come today. It's going to take 2.5 years to come. So that was the first priority. Simultaneously, we are also looking at second-hand ships. So that though we are in the market for it, we are looking to see if we find something, but it's not very visible. I think with the Red Sea crisis, etc., the market has become a lot more tighter. So we are waiting to see how things progress, and hence we are not adding that to the capex yet, because it's still very, very tentative. So please bear with us, because it is that time where it's really very unpredictable when it comes to visibility for what's available in the market.
Sure. And sir, so assuming this you go ahead with the new ship order, which eventually would come by, say, in next 2-3 years. So what is the growth outlook for the Seaways segment in the current scheme of things? Because this year we have seen sort of a degrowth in that particular segment. That's primarily could have been because of the dry docking and lower capacity available, and also some correction in the freight rates. How do we see that segment growing in FY25 and 26?
So in the last year, it did not. We had a 7% degrowth, because we knew that, of course, the rates that we had got in the past because of the post-COVID, etc., had to come down, and they did come down. The other aspect was that we did not do international routes as we had done that time opportunistically. However, this financial year FY25, we again expect the volumes to be moderated. We have some impact because of the dry dock, but then in Q1, all the dry docks will be done. So we should start seeing their impact, the positive impact over the full course of the year. So the expectation for FY25 is flat. The FY26 expectation is essentially going to be built on if you're able to acquire a second-hand ship end of the year or early next year. Clearly, we are not factoring in anything for the new ships, because they will not come for the next 2.5 to 3 years. 2 to 2.5 years. Sorry.
Sure. So just last question. Our margins on the blended basis has been in the 10 to 11% sort of a range. So do we see that improving here? Because the Seaways, we don't see much growth coming in, which is the highest margin segment for us. So how do we see the margins shaping up in the supply chain and the freight business ahead?
As I mentioned, supply chain should definitely see a positive growth this year as well, and so should the freight business. So overall margin should creep up a little bit for sure. It will not jump up like it did because of the Seaways margins, but it will certainly creep up.
Got it, sir. That's all from my side. Thank you and all the best.
Thank you.
Thank you, sir. The next question is from Mr. Kripa Shankar. Sir, please go ahead.
Good afternoon, and thank you for the opportunity. So my first question, Vineet, is on your guidance of top line and bottom line growth. Now, what you're citing is more of a flattish trend in Seaways business, and LTL, given the competitive intensity in LTL piece of it, freight should marginally improve, but again, most of the growth will come in from supply chain business. Now that translates to close to about high teens sort of growth in supply chain business. Is my understanding correct?
In mid-teens to high teens, yes. We supply chain business is about 39% of our overall business today, and freight is about 44% of our overall business. Seaways is only 14%. So that, the growth there is not going to have a major. I mean, there's not clearly not major impact because of that. So yes, supply chain will capture a large part of the top line growth as well as the bottom line growth, as well as trade should also see some top line growth. It's not that it's going to be completely flat.
Got it. And on the freight business, while we had added branches and boosted our infrastructure to cater to incremental, demand which was coming our way on the LTL side of things, is it quite likely that the fixed cost which were not absorbed in FY24 due to scaling up, you will see that the margins will revert back to 4.5%, or are you expecting the margins to remain at these levels because of competitive intensity?
No, we do expect. See, the margin has also had an impact, not just because of fixed costs, but also the shift. And you're right that the certain amount of fixed cost increase did happen because of the anticipated growth in LTL business, and if that did not come through, some of that margin pressure came in. But some of that capex will, some of that capacity addition in the LTL side of the business has happened, and some branch network will get expanded. We're looking to open another 75 branches this year. That does not add significantly to the cost structure. What adds is the lack of volume in the truck, because any truck that goes less uh, 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 more empty, you lose more money. So the idea is to see how we can utilize the trucking infrastructure that we have, and that fortunately for the freight kind of business is not exactly always a fixed cost. It's a variable cost also, because we employ a truck when we need it, rather than in an express business you have to have the truck, you have to have the schedule, irrespective of whether you need it or not. We do have that on certain routes, but not entirely. So that's why the business has a lot more flexibility. And going forward, with the thrust on LTL business, I expect the margins to also start improving. So I think we should get back to the 4-ish% level.
Understood. One last point on the LTL piece itself. Now, with respect to the undercutting of pricing, what you're seeing, how would you rate the price difference vis-a-vis the average yield of the industry? So how much lower is it, and which is resulting in impact in volumes, or rather shift happening to these companies?
I would not be able to give you an exact number, but typically we are anywhere, route wise or just generally 10 to 20% lower than the express type of companies.
No, what I meant was the incremental competition which is coming in. Now they are also undercutting quite extensively, is what you highlighted, right? So how much of a difference would that be vis-a-vis our current yields?
Yeah, so that's what I'm saying. The price differential is about 20%, let's say 10 to 20%, depending on routes and sectors. So our yield is lower by that.
Okay.
And hence if they are able to bring down the price incrementally down, then they hit our cost structure, which then the customer might want to switch.
Okay, got it. Thanks, Vanith. I'll get back in the queue. Thanks.
Thank you.
Thank you, sir. The next question is from Mr. Pinaki Banerjee. Sir, please go ahead.
Hello.
Mr. Pinaki?
Yeah, hello. Am I audible?
Yes, please go ahead.
Yes, sir.
Okay. Good evening, sir, and thanks for the opportunity. So, in the presentation, you are giving a growth guidance of 10 to 15%, but considering the fact that we are in the midst of the elections and also the monsoon setting in, you have also mentioned that Q1 will also be flat. So, basically, you are expecting to make up the growth actually will be happening more on the second half of this financial year. Is my understanding correct?
Sir, I think you're on the mute, or your voice is not coming.
Can you hear me now?
Yes, yes. Yes.
Okay. Sorry. I'm saying that yes, the business is still going on as is, but it's just that sometimes right now it's a little slower. However, you're right, some of that will come in the second half. Also, we're expecting the festival season to be better. So yes, but generally speaking, business continues, and I think from June onwards, July onwards, it will be at the same nominal levels as it has been generally. You're on mute, Mr. Pinaki.
Yeah, hello, am I audible?
Yeah.
Sir, your debt levels have gone up from 62 crores to 150 crores roughly. So what is the actual reason for this?
So we have taken some new loans against the truck purchase, which is close to 50 crores, but it also includes lease liabilities as well.
Okay.
Yeah.
Sir, last final question, sir. You are serving various sectors like agriculture, chemicals, automobiles, etc. Sir, from which sector are you expecting the maximum growth? Like we see that automobile has done phenomenally well in FY23. So which sector are you harping on most of the growth to come from?
A lot of the growth will also come from the automotive sector, for sure.
Okay.
Then, of course, we are seeing good growth on the infrastructure side kind of companies, which include the engineering companies or related segments. And as well as that, there are always new segments that are growing, like chemicals and others, which will continue to add to the segment impact.
Okay, sir. Okay, fine, sir. That's all from my end, and thanks and all the best for the future.
Thank you.
Thank you.
Thank you, sir. The next question is from Mr. Sunil Kothari. Sir, please go ahead.
Thanks for opportunity, sir. Vinitji, broadly, the way I would like to understand is you over a time you are always moving ahead in the value chain. You are reducing competition by increasing your services and your qualities. So, which are the things you are doing to say keep away this unhealthy competition, like full load truck you move to half load or lower load, and this supply chain systems, so many technological investment you are doing. So would you like to understand the entry barriers you are able to create or you will be able to create and sustain this type of margin and profitability?
Yes, the entry barrier is essentially starts with the fact that you choose the right customer, because there are many of our competitors who are essentially chasing growth and not profitability. So when you choose the right customer and you work with the right customer to provide them value, they also appreciate that and they work with you together. And there itself, then when you create value for them, you create the moat, you create the differentiation. And value comes from various factors. It could be technology based, it could be the network effect, which is the branch network, etc., or the service effect, where we have the services, or the multimodal effect, where we are moving customers to different modes of transport. So all of these factors, and then ultimately you provide a solution to client. And when they like that, they prefer that, then they remain sticky with you. And that's been our philosophy. And if you see the last 25 years, the consistency of our growth is essentially based on this platform.
Right, sir. And one more question, just to understand this. There are two types of customers who, one is they themselves manufacture everything like Voltas, just for the example, air conditioning. And second is type of nowadays, there are many who is increasing outsourcing. There are custom manufacturing which is going up. So how is the mindset of theirs, which is better customer or where you see opportunity?
See, all types of customers, whether they are self-manufacturing or getting manufacturing done outside, contract manufacturing, require a robust supply chain, and that supply chain is a factor of movement, warehousing, as well as delivery. So all of those things have to be done irrespective. And if companies are who want to really lead in growth, grow their businesses, etc., focus very strongly on supply chains. So I think this is an uh, ongoing work with many clients on, irrespective of the kind of uh, production model they have, manufacturing model they have, they will have certainly have requirement for logistics.
Do we have good enough customers from this EMS or contract manufacturing side?
We do work with some of them, and it's obviously a lot of them are starting up and growing more. So that's work in progress.
Great, sir. Thank you. Wish you all the best.
Thank you.
Thank you.
Thank you, sir. The next question is from Mr. Anshul Agrawal. So please go ahead.
Hi, thank you for the opportunity. Viniji, my question is on the lines blurring between LTL business and express operators. Is price the only reason why this is happening? Because I always thought, because if that's the case, then this seems to be a structural change versus some tactically some player reducing pricing. Because I was of the opinion that in LTL business cargo profile differs, there are shorter routes versus an express route, and all that stuff. But is pricing the only reason why we are seeing loads shifting from LTL to express operators?
So some of that is pricing, and that's not specific to all industries, but some specific types of companies might want to shift there. But the LTL market is robust by itself because there are lots of types of products that move in the LTL market which are not done by the express. For example, there could be a 200 kilo pump or a small turbine. Now, all of that is not really going to be going by express because it is too expensive. Similarly, there are other engineering products, or there are some other products that will not go through express. Sometimes they are little lower value products also. So I don't think it's a direct competition. I think there are sectoral some types of competition and sometimes on specific routes. So I do not think it's a generalized comment.
Got it. Would you be able to give us some examples around which are the overlapping products or sub segments wherein customers may want to switch from LTL to express provided the pricing agrees?
So let's say, for example, some apparel type of companies which were a little bit on the lower value side, and they want to now they are using express because they have brought down their pricing. So like this, few sectors like that.
Got it. Got it. Very useful. Thank you, Viniji. My second question, if I may.
Yeah.
So even in the freight business, is there a contraction in our FTL margins, or the contraction is margin is only on the back of margin compression in the LTL business?
So there's no margin compression per se in the LTL business. It's just that there is, well, I guess you can say that because I think a certain amount of fixed cost gets attributed to the
Network.
margins of the yeah. So that is there certainly. And on the FTL side, I think there's a very small margin compression, not much.
And this would be on the back of increased competition in the unorganized market or general slowdown in volume trajectory?
Yes, I would attribute it to just general slowdown, not specifically any hyper competitive situation.
Got it. Thank you so much.
Thanks.
Thank you, sir. The next question is from Mr. Ronald Sioni. So please go ahead.
Yeah, thank you, sir, for the opportunity, and congratulations on a very good set of numbers in a tough environment. First thing on the the multimodal mix which you highlighted at 33%. So if you can tell us what was it last year, and as you had also highlighted that this is a core competency. So what is your target going ahead?
So we are continuously building on this. We have probably moved 100, 200 basis points on over last year in terms of the volume. Of course, as you know, the CVA's volume has come down a little bit, so that not volume as well as uh, the revenues have come down, and hence it has not grown as much as it would have generally. And the anticipated growth is that we will continue to talk to our customers more and more and try to push them towards rail services and coastal shipping services. So I'm hopeful that 100 basis point type of increase every year, 200 basis point would definitely help move this number. You're on mute.
Ronald, you're on the mute.
Yeah. Yes. I was trying. So, thank you. And secondly, on the seaways, like you said, one issue, because I was under the impression that you are looking for two smaller ships and probably one second-hand ship. So, is it not finalized that whether two smaller ships or one bigger new ship in the
No.
seaways?
As I said, last year we had finalized two smaller ships and we placed the order, but the supplier backed out of the order, and so we had that got cancelled. So we are now looking to again find a ship yard that will accept those orders. So we are still in discussion with some of them.
But it would be a smaller size only, right? Not the
Yes. The
larger
two
ones.
ships are smaller ships only. Yes.
Okay. Thank you very much, sir, and best.
Thank you.
Thank you.
Thank you, sir. The next question is from Mr. Divyansh Gupta. So please go ahead.
Yeah, hi. One quick question on the ship order that we are given to that shipyard, Japanese shipyard. So do we have any money stuck with them or everything? No money
No
exposure.
money.
Nothing
No
is.
money exposure. No.
Got it. Second question is with respect to the cash flow statement. So if I go in the cash flow statement, there is something, there is an increase in other assets. And if I look at the last year balance sheet, it was attributed to something known as capital advances, or it was at least majorly caused due to capital advances. So what is this nature of capital advances? Why is it being incurred?
So basically, these are the advances for, let's say, building new warehouses, new hub centers, and those are in the building and under construction. So they are also categorized as other assets.
So mostly capex related items which
Yes,
are being
they are all capex related items.
Understood. And we need third question with respect to the trans-system business, right? So now it is actually pretty comparable to a freight business, like 1,600 crores versus 1,000 crores of revenue. So if you can and growing very fast. So can you give more light on, let's say, apart from, let's say, Toyota, as you mentioned in the opening remarks, what is driving this business to grow at such a fast pace and without putting more capital employed, our profit has almost increased by 50%. So some light on what is driving this whole business and how it will evolve.
So this business is essentially managing the logistics of Japanese automotive companies, and the primary customer here being Toyota, and of course Suzuki, because Toyota and Suzuki are working quite closely together. The business is actually more akin to supply chain, not freight, because it is complex in terms of the logistics services and entirely automotive logistics. So that's the similarity. The business has grown because, as you know, Toyota production has grown tremendously, and they're doing quite well. And the business does not require additional capital, more a little bit of capex that is required that gets self-funded, and also the working capital requirement is also self-funded. So does not require additional capital, and the trajectory for the business remains positive. I think we should look at a 20-25% top line growth also for this financial year, with a similar growth perhaps for the bottom line as well.
Got it. So is it only Toyota plus Suzuki, or let's say Toyota is like 70-80% or some?
It's a high number, but it's a high number, but it's all the Japanese automotive companies, both on the OEM side as well as on the supplier side.
Got it. And what is the exact role that TCI plays? So are we running those, let's say, supply chain solution, trucking, logistics, everything, or what is our role in the JV versus Suzuki or Toyota's role in the JV?
No, just Suzuki Toyota are not part of the JV. Mitsui and companies are JV partner. And this is a company where we
Hello.
have come. Yeah, can you hear me?
I can hear you now.
Yeah. So Mitsui and company is our JV partner, and we have both of our teams have been seconded to that company, which runs the operations there. The business also, the joint venture also outsources some of its logistics to TCI as an operator. But the business is run by its own independent team.
Got it. So if I have to say that while TCI is one of the vendors to the Mitsui, to the JV,
That's
but
right.
operations is managed by TCI seconded team, whereas Mitsui brings
TCI
the
and
connects
Mitsui
of the
seconded team.
Japanese.
Yeah. Correct.
Got it. And Mitsui brings in, let's say, the clients, or let's say whatever they have onboarded Toyota as the biggest client for the JV.
Yes, I mean, it's 25 years since this JV was formed, so I guess we now have an equal role to play, both partners.
Got it. And any plan of expansion of more clients in that JV, or it's
ongoing. I
primarily
think.
focused on?
See, Japanese companies today have more than close to 60% market share, primarily driven by Maruti, of course, and OEMs are also quite large. So there is a large opportunity, and I think the focus around Japanese OEMs really helps the company to acquire clients specifically.
Got it. And just last question, when you in one of our earlier discussion, you had mentioned that, let's say, the automobile is 40% of the business for TCI, then this 40% more or less resides in the JV.
No. I said 40% is manufacturing. Today, India's manufacturing GDP, 40% is automotive sector. So it automatically becomes a large portion of our logistics business.
Got it. Understood. Yeah, that's all from my side.
Thank you.
Thank you. All the best.
Thank you, sir. The next question is from Mr. Vikram Suryavanshi. Sir, please go ahead.
Yeah, hi, good evening, sir. Can you just share? I think I missed the branch addition number in freight segment. What was that for full year, and how is the branch addition plans going ahead?
30 was added last year, Vikram, and we are planning to add 75 this year.
75.
Yeah.
Okay, and in basically, if you look at same business, apart from the non-auto, how is the progress or customer mindset to onboard 3PL players, and which are the segment where we can see opportunity for, let's say, 3 to 5 years in terms of SCM basically?
So very good opportunities has in the last, I would say 6-9 months, we are seeing a very strong pipeline coming up. I mentioned about the case study about an FMCG company. There are several FMCG companies that are lining up for this kind of structural change in their business. Then we are talking to now, there are some e-commerce companies also that are coming up. They've become significantly large also. So we're providing fulfillment services to them. Consumer durables are also quite active and hot nowadays from a perspective of outsourcing more and more of the logistics. We are seeing chemical companies talking to us about facilities. Retail is also quite attractive, and we're talking to a number of companies there. So we're quite bullish on the overall non-auto sector as well, and we're seeing good traction in everywhere.
Okay. And in case of freight business, so is it largely because I guess we also have regular customers in freight and renew contracts regularly, but is there any significant portion which will come to on a spot basis to us on freight, or it is more like a routine customers with more like a contract kind of a business?
More routine customers, and there are spot customers also that come. I think I don't have a number, but definitely about 25% of customers do come on spot basis.
Okay. And is there any opportunity to create you might have seen a lot of players come and create platforms for truck operators for their convenience for booking and load and all that. And since we are in a freight business, so already know much better about IT systems. So any opportunity for this sport business or any creating platform as additional service or revenue opportunity for us, or it's still what are your views on that kind of opportunity?
So we do operate our own internal apps where we are, our own requirement is put on that app. And when we have suppliers who are there who have onboarded onto that, they can bid for that kind of our requirement. So that exists already. That has been there for many years.
Okay, but is there any potential to monetize this kind of service and expand to
No,
larger?
no.
Not really.
That's not our business. Our business is to service our customers. So there are, I think, a lot of other people doing that, and we might invest into those businesses separately, but not monetize it internally.
Understood. Okay, thank you very much.
Thank you.
Thank you.
Thank you, sir. The next question is from Mr. Vikas Khatri. So please go ahead.
Good evening, Vineet. My question is one thing, two or three questions. First is how in last year LTL yield has changed? Has it improved because competition is coming? So how our yield has improved or gone down? Second is largely a conceptual question since DFC is coming and recently DFC did trial of the RoRo service. We have seen RoRo very successful on the Konkan Railway. Do you think impact in 3 to 5 year term on northwest or northeast lane because of the RoRo on FTL pricing and FTL demand?
See, the rail business DFC is something that is a game changer for the country as a whole, and that would help to move the cargo to more to multimodal network, which is great for the country. And it's not that it is going to affect us negatively. I think we are piggybacking on this kind of an increase and opportunity as well. So it will possibly lead to some pricing pressure. I think because with the DFC, you have 2x the kind of length of the train, and you do double stacking as well as double the speed. So almost an 8x kind of an improvement in productivity. So certainly, I think there is space for it to have a very positive impact.
And second question was on the how yield has moved.
Yield has not really changed much. I think we've been trying to maintain the yield structure to great extent, and I think loss of business is what has driven profitability to be a little lower on the freight side, or like a lack of growth of business. So, but cost structure revenue structure remains stable. Also, I think we've been able to push customers for some price increases wherever possible because of inflation.
Thank you.
Thank you, sir. There are no further questions. Now I hand over the floor to Mr. Ashish Tiwari for closing comments.
Thank you, Simran, and thank you very much to all of you again joining the call. I hope that all the questions have been answered. In case you have any further query, please feel free to connect with me. All of you have my contact number and email ID. So see you in the next quarter again. Thank you so much. Take care.
Thank you, everyone. Thank you.
Recording stop.